Welcome to The Explainer. So today we're unpacking the genius behind two of Warren Buffett's favorite investments. But what's interesting is they're surprisingly overlooked. We're going to go way beyond the famous stock picks to uncover a powerful strategy that's been hiding in plain sight.
And get this, Buffett himself called these assets a legacy, not just profitable, but a foundation built to last for generations. He wasn't just thinking about the price he paid, he was thinking about how the income from them would just keep growing for decades to come. Okay, so let's dive right into this. We're going to deconstruct these two stories to find the common blueprint, that simple but brilliant logic that you can actually apply to your own thinking.
All right, our first story. It doesn't start in some fancy boardroom on Wall Street. Nope. It begins right in the heart of America's farmland. And, like a lot of great investment stories, it kicks off during a time of serious financial distress. The year is 1986. A huge bubble in farm prices has just burst, and it's created total panic. I mean, lenders are failing, farmers are losing their livelihoods. The only thing growing out there is fear. But while everyone else was running away from the crisis, Buffett, well, he was running towards it. He saw a rare opportunity. He went and bought this 400-acre farm in Nebraska for just $280,000. And he bought it directly from the FDIC. That's the government agency that has to step in when banks fail. Now, to put that price into perspective, it was a tiny fraction of what a now-failed bank had loaned against that exact same property just a few years earlier. He was buying a really productive asset at a complete fire sale price. And this just shows the contrast perfectly. The market was completely consumed by fear, just screaming that farming was a terrible investment. But Buffett's analysis? It was simple and totally detached from the panic. He calculated what he called a 10% normalized return, which is basically just a conservative guess of the farm's long-term earning power. He just figured that, productivity will go up and crop prices will eventually rise. He focused on the farm's output, not the market's mood. And boy, did his conviction pay off. You fast forward to 2014, the farm's earnings had tripled, and the property itself was worth 5 times what he paid for it. That's the power of focusing on long-term value. Okay, let's move on to our second case study and see how this whole thing builds. We're swapping the cornfields of Nebraska for the concrete jungle of New York City, but you'll see the pattern is remarkably similar. So now it's 1993, and another bubble has burst. This time in commercial real estate. And once again, all that turmoil is putting quality assets on the auction block. Buffett finds out about a retail property right next to NYU that's being sold off by the Resolution Trust Corporation. Yep, another government agency created to clean up after failed institutions. Now here was the masterstroke. While he was analyzing the property, he noticed it was being pretty badly managed. But then he spotted this one key detail that it seems like everyone else missed. While most of the tenants were paying around $70 per square foot, the single largest tenant was paying a shockingly low rent of just $5 per square foot. And here's the crucial part. He discovered that this tenant's super cheap bargain basement lease was set to expire. Think about that. This wasn't just a property with decent current income. It had a massive, locked-in rent increase that was virtually guaranteed in its future. A huge boost to earnings was already baked right into the deal. The result of that one insight was just spectacular. The property turned into an incredible cash flow machine. The annual distributions, that's the cash paid out to Buffett and his partners, now exceed 35% of their original investment, every single year. So we've got a farm in Nebraska and a storefront in New York City. Two completely different assets, 2 different decades. So what's the common thread? What's the simple yet profound blueprint that connects both of these incredible successes? Well, it really just boils down to 2 simple but incredibly powerful principles. First, buy after the bubble bursts. Use all that widespread fear as your signal to go acquire great assets at a discount. And second, focus on the future earning power. Ignore all the daily price swings and analyze what the asset can produce for you over the long haul. Okay, this all sounds great in theory, but let's be realistic. Trying to apply this blueprint today presents its own set of challenges, especially for the average person. I mean, let's be honest, directly owning an asset like a 400-acre farm isn't exactly straightforward for most of us, right? You need a lot of capital up front, you need specialized expertise to actually manage it, and access to the really good deals is often limited to insiders. And this really brings us to the key takeaway here. You might not be buying a 400-acre farm tomorrow, but the blueprint,
That's timeless. The core lesson isn't really about farms or real estate. It's about a mindset. It's about having the discipline to ignore all the noise, the courage to be greedy when everyone else is fearful, and the wisdom to focus on what an asset can earn over the long term. The real question this leaves us with is not whether you can buy what Buffett bought, but whether you can learn to think how he thinks.